Hello everyone, welcome to the 11th episode of Question of Money. Similar to our previous episode, we continue to take questions from our viewers on personal finance and how to manage their money. To answer all the questions, we have with us Aarati Krishnan, Consulting Editor, The Hindu Business Line. Welcome ma'am to today's episode.
Hi.
We have our first question from Sanjana, who is asking, if she doesn't maintain her Demat account, will it affect her CIBIL score?
A CIBIL score has nothing to do with your Demat account. Credit bureaus like CIBIL, they actually track your loan repayment behavior. So they track the number of loans you take, what is the value, when you're repaying them, whether you're repaying on time. Based on that, they assign you a credit score. Therefore, the assets that you own like shares, bonds, etc., which are in your Demat account, they are not affected by what happens to your CIBIL score and vice versa. Your Demat account can become dormant if you don't make any transactions for a whole year. There are charges on your Demat account like account maintenance charges, etc., which keep getting debited from your account. Suppose you are not doing anything with your Demat account, these charges can become overdue and the account may need to be reactivated. But otherwise, CIBIL has nothing to do with your Demat account.
So the second question is from Nageshwar Rao. He is 50 years old and works as a software engineer. He is asking, what corpus should I invest to have a 1.5 lakh rupees as a passive income?
So if you want a really simple and straight answer to this, it's quite easy to make the calculation. Today you are getting about 7.5% from FDs as interest. If you invest 2.4 crore rupees in a bank fixed deposit, you will easily make 18 lakh rupees a year and that will translate into 1.5 lakh rupees a month. But actually, if you are looking at this from a retirement perspective, that is you want to basically hang up your boots at 50 and you are hoping that you will get passive income for the rest of your life, say until 85 or so, then the calculation becomes quite complicated. There are many variables that go into this calculation, the amount that you invest, the number of years you live, the rate of return that you earn, the inflation rate, where you invest, equity versus debt, so on and so forth. So to make a ballpark calculation, to get a 1.5 lakh income today, which will keep growing at the rate of inflation for the next 35 years, you will need a corpus of about 5.2 crore. Suppose you stretch your longevity to 90 years and you also earn just about the same rate as inflation on your investments, then your corpus can be upwards of 7 crore. So you can see how much these numbers vary based on these assumptions. You should be using the many online retirement calculators to arrive at this number for your ideal corpus.
Our third question is from one of our viewers, Joel. He has a salary of 35,000 and has an emergency fund of 1 lakh rupees. Now he plans to invest in stocks and is confused about which are the stocks that he should invest in and how to go about it. So what is your response to that?
It's good that you are asking about your investments after setting up an emergency fund, that too at a comfortable 1 lakh rupees. But if you are just making a start on your investments, you should not be going directly into stocks. Suppose you start buying stocks on your own, some stocks may do very well, some may really flop and you can lose a lot of money. So we suggest that if you are just a beginner investor, you can take an exposure to the stock market via equity mutual funds. We have explained what mutual funds are in great detail in another video and please refer to that. Before you make a start on your investments, you need to put out something called an asset allocation plan. Decide how you are going to divide your investments between debt and equity. Once you decide on this, the equity portion can go into equity mutual funds via SIPs or systematic investment plans. You can choose index funds for your SIPs, which will not require much tracking and will come at low cost.
We have a question from one of our viewers, Kritika. Her CIBIL score is 630. She wants to know how to improve it.
There are many variables that go into setting your CIBIL score and we are not even aware of what are all the variables that the credit bureau takes into account. But generally, set reminders so that you repay your EMIs and loans on due date and do not delay beyond it. So that will help your CIBIL score. Beyond that, make sure that you maintain one credit card or loan account where you've been servicing your payments on time for a very long period. The longer your credit history, the better the chances of improving your credit score. Also make sure that you are not maxing out your credit limits on any credit card that you take. If you want, set a higher credit limit on your card in conversation with your bank so that you use only a fraction of it. Do not take many overlapping loans at the same time. Try to take one loan only after repaying others. These measures should surely help you improve your credit score of 630.
The next question is from Lakshmi. She plans to get married in 2025 and wants to save 2 lakh for this purpose. Now she has a salary of 45,000 and her monthly expense is close to 25,000. So she wants to save 2 lakh in a year's time. So how can she go about it?
Since you have only 1 year to get to this goal, which is your marriage, you really do not have options like shares, mutual funds, gold or real estate to invest in, because if you invest in these assets, within 1 year they can be very volatile and you can lose some money. So the only option that presents itself is actually a bank deposit. Since you can save regularly and you are saying you have a surplus of about 20,000 rupees a month, we suggest that you consider a recurring deposit with any bank. The leading banks will offer you something like 7 to 7.5% for recurring deposits. If you invest 16,000 a month for the next 12 months in RDs, you can easily get to your 2 lakh amount. If you want to max out that return a little bit, you can go to small finance banks and do the same RD and you can get an 8% return on those accounts.
We have the final question from Ranjit, who is working in the IT sector and he is 35 years old and has an annual income of 5 lakh. Now he is confused about how to plan his retirement and how to create a retirement fund for himself. So what are your thoughts on that?
Since you are working in the IT sector, you must surely be having an EPF account with your employer, which is the Employees Provident Fund. And both you and your employer must be contributing to this fund. So if you plan to retire only at 58 or something, the money accumulated in this account can definitely help you. But beyond this, if you don't like the rigidity of this EPF, then you can consider opening an NPS account, National Pension System account, and a PPF, which is a Public Provident Fund account. Now the PPF gives you a very fixed return guaranteed by the government year after year at about 7%. The NPS lets you invest in market investments like equities, bonds, government securities, etc., where you can earn a higher return. We have done separate videos on both the EPF and NPS. Do refer to them for greater details on how you can go about this. So we've been receiving a lot of questions from our viewers and we've been answering them. In our upcoming video, we'll be discussing what kind of accounts a new investor needs to make a good beginning on his journey. Also, don't forget to check out our playlist. We've done 10 episodes of Question of Money so far and you'll find a lot of useful information in these videos. Do check out the playlist.